Well, hello everyone. This is December 21st, 2016, and this is the SDRAFocus webinar for this date, for December 2016. And today we'll be talking about annual valuation of self-directed retirement account assets. It's particularly apropos today or in December, because starting in January, your custodian will be asking you for valuation information on your assets held by your self-directed retirement account. And it's important to understand how to communicate that and what they're actually looking for. So for our agenda today, we'll be going over a calendar of events that happen during the year that's relevant to the valuation process. We'll be talking about the valuation process itself and some calculation methods. I'll give you some special notes on Roth conversions. And then we'll talk about valuation reporting. And then we'll return to the issue of valuation options so that you'll understand what the options are based on how things are reported. So here's the calendar for 2017. Of course, in December and also January of the following year, of January 2017, you'll be getting requests for valuation from your custodian. The valuation date that they're looking for is the value of your self-directed retirement account assets as of December 31st, 2016. And the reason they're asking you for those is because they're not readily marketable assets, so they're not easily valued based on a public market. So the self-directed custodians rely on the account owners to report and the managers of entities that are held to provide valuation information to them so that they can do their annual reporting with IRS, etc. The hard-to-value assets should be into your custodian by March 31st. So you have from January 1 through March 31st to provide the valuation of assets that are not otherwise publicly marketable. The responsible party for that is the entity officer. It could be a president, treasurer, clerk of a corporation, or the manager of an LLC. And then also along with that, during that same period of time, on February 1st, the custodian has to issue Form 1099-R, which is the Form 1099 that itemizes distributions and other items of income for the IRA owner. And then on February 28th, if the custodian is submitting those by paper, they have to go to IRS. And then there's a hard deadline of March 31st if the custodian is e-filing the Form 1099 with IRS. So on March 31st, also, the valuation for the 2016 value is due. And that's, again, done by the entity officer or manager or owner of the retirement account. They're primarily responsible. And the next event is when the custodian makes a record of what the value of the assets in your account are, and they send that to you, and they also file it with IRS. So sometime after May 31st, unless they go on extension, sometimes they go on extension, but sometime after March 31st, you're going to get a report from your custodian. It's Form 5498. If you have an IRA or a SEP IRA, anything but a employer plan. And that's going to report a bunch of information that we'll go over. Also on July 31st, for solo K plan trustees and other qualified plans, that's when the Form 5500 is due. That's kind of the same thing as the 5498 for a qualified plan. But that's only for plans that have assets in excess of $250,000. And then October 15th is the hard deadline for recharacterizing Roth conversions that you've done during 2016. You can only do that by October 15 if you have paid your taxes on time and file your return on time, even if it's gone on extension. That October 15 deadline doesn't depend on when you extended your income tax return to. That's the date on or before which you have to make a recharacterization and get a report to IRS. So let's talk about the valuation first, evaluation process. The first thing that you have to do is, of course, you have to identify the hard-to-value assets. And those could be, besides your LLC interests that your retirement account holds, the LLC is going to hold, in many instances, hard-to-value assets other than LLC interests, like real estate, etc. So those are hard-to-value assets too. So you have to take a list of all of the assets, including your LLC interests and the assets that are held by the LLC, and make sure that you know which ones are the hard-to-value assets. So that's if you hold stock in a closely held corporation, and by closely held we mean that it's not readily tradable on an established market for the item. It could be long or short-term debt obligations. Again, those that are not traded on an established securities market for those obligations. Ownership interests in closely held LLCs, real estate holdings, ownership interests in closely held partnerships or trusts, option contracts that aren't offered on established option markets, and other assets that are not ascertainable, that don't have a readily ascertainable fair market value. And then also, it's one of the things that you have to report on the 5498 that the custodian has to report is a particular item that says, are any of the values listed composed of more than 2 of the above? So when you're identifying the assets with the value that goes to the custodian, they need to know whether they're using more than 2 assets in their account. So there are a bunch of different options depending on the type of asset that we're talking about, and I'm sure that many of you are familiar with these, but I'll just review them quickly. Of course, if you're talking about closely held stock, there's always the book value, and that could be the original amount that's been invested, or it could be the book value of the corporation or whatever your interest in it is under current financial statements. Now, the original investment amount is going to be less and less, let's say, accurate as time goes by. So as time goes by, you're more and more going to be relying on current financial statement information. Of course, you can have the stock valued by a business appraiser. It has to be a qualified business appraiser, and IRS has regulations about who those are. So when we talk to appraisers, we want to make sure, business appraisers in particular, we want to make sure that they are qualified business appraisers and that they've satisfied all the requirements for IRS to be so. Also, of course, shareholders have inter-shareholder agreements, and if those are negotiated arm's length, not, let's say, within a family, they're between third parties. If there's a buyout value in it, or there's a formula, you can come to the value of the entity or the interest in it using that. And a lot of times corporations revalue their stock on an annual basis because of their buyout arrangements and insurance purposes. And then, of course, if you had a recent offer to purchase it from somebody, that might also be an indicator of value. Long or short-term debt obligations, everybody would normally think that it would be the current principal balance plus accrued interest, and that actually is the IRS method. That is the method that they expect you to use unless there's some other factor involved. And those other factors could be whether the note is secured, whether there's a default status, in other words, is it in default or has there been a history of default, and is the debtor creditworthy. Those factors, you wouldn't normally weigh them yourself. You would want an appraiser familiar with appraising promissory notes to make those determinations. And I have actually had a number of situations where appraisers have actually discounted the value of promissory note for a number of different factors. Then, of course, there's ownership interests in closely held LLCs or partnerships. And again, we have the same factors that we talked about for corporations. And then there's, of course, there's real estate. The purchase price, of course, is an excellent indicator of the current value if you bought it from an arm's length third party. But of course, as time goes by and the value of the property goes up or down, the original purchase price may or may not be particularly relevant or accurate. So you might want to get a real estate appraiser, and that would have to be a qualified real estate appraiser. Same factors as I talked about before. Or alternatively, in some circumstances, and we'll talk about those, you might also want to use a real estate broker's opinion of value. Also, interests and trusts may be subject to valuation. We don't have too many of those, but you might look at the trustee's accountings, or you might have an appraiser appraise the assets inside the trust and determine what the value of the beneficial interest would be. This would particularly apply to business trusts as well, and we might use the other factors for LLCs, partnerships, and corporations. And then, of course, there are option contracts that aren't offered on established option markets. So you might use the recent purchase price of the option, or you might take the difference between the property's fair market value and the option price to determine if the term of the option is getting very short. So your calculation would be based on, might be based on factors relating to the remaining term. So the second step would be to choose your best option to establish the fair market value of the specific assets. And we'll talk about that a little bit more, and we've just been talking a little bit about that, but we need to get through the other parts of this before we can return to it. So next we're going to assemble the information for all assets in the entity, and then we're going to calculate the net value of the assets held by the self-directed retirement account. So, for example, the real estate, promissory notes, LLC interests, and cash. So, and then we're going to report the value to the custodian by March 31st. So, let's take an example of calculating the fair market value of LLC interests. And it's important to understand that if there are more than one LLC owner, it's not a single member LLC, that there are really two levels of valuation that we have to be aware of. The first level is the value of the fair market value of the assets held by the entity. So that could be the real estate that's held by your LLC or promissory notes or whatever it may be. It's the assets, the underlying assets inside the LLC or the entity that has to be valued. And we need to get the fair market value of those assets. And then the second level is the member level. So not only do you have to know what the fair market value of the assets held by the entity are, but then you're going to value the units of interest in an LLC, for example, as a separate item. Because in fact, for a lot of our clients who have single member LLCs or interest in multi-member LLCs, it isn't the assets inside the LLC that your custodian holds, it's the LLC interests. So it's the LLC interests that they're trying to determine what the value is for their reporting purposes. And if it's a multi-member LLC and you own less than 50% of the value, your retirement account does, you also have to take into account lack of control discounts and lack of marketability discounts. So let's take a look at how that works. So here's the formula for calculating the fair market value of LLC units in a single member LLC. So the first thing is you have to take your cash. Easy to forget that. And that would be determined by what is the checkbook balance of your checkbook. You might also have savings accounts, whatever the account is as of December 31st, and the value. You might also include accrued interest, and that you can probably get on your January statement, plus the fair market value of the hard to value assets. Then you take off your liabilities, and that's you get your fair market value of all the LLC assets, and that is also the fair market value of your LLC units, because the LLC units are essentially valued at the same amount as the underlying assets held by the LLC in a single member LLC situation. And the reason for that, of course, is that it is a pass-through entity, and we're really just talking about the assets that it holds. It's just the LLC holds them for legal title purposes and for third-party creditor avoidance purposes. But in terms of IRS valuation, the fair market value of the LLC units is identical to the total net fair market value of the assets held by the LLC. So then we might have a multi-level, multi-member LLC. And that formula is very similar to the one for a single-member LLC, but it has one extra step, and that is to add the discounts or subtract the discounts to value to get to the fair market value of the LLC units. So let's take an example. Here is an example of a single-member LLC valuation. The checkbook balance turns out to be $3,475.83. The value of the real estate that's held by the LLC is $547,000. It has an outstanding mortgage balance of $200,000. And again, just to remind you, that means that the retirement account is going to have some form of unrelated business taxable income. But that means that the net market value of the real estate is $347,000, not $547,000. And just for simplicity purposes, we're not including any other assets. So the subtotal of all of the assets is $350,475.83. There are also outstanding liabilities. There's a plumber bill, for example, and things like that of $2,300. So the net value of the LLC's assets and liabilities and of the units is valued at $348,175.83. That would be the value, along with an itemization that looks just like this, that you would report for the value of the LLC units to your custodian. So then we have the fair market value of a multi-level LLC. So here's the formula for the discounts that's involved. So the first thing is that we calculate the net value of the entity's assets as per above, just like a 100% owned LLC. And then we determine what the percentage of the ownership interest is, and if it's less than 50%, or 50% or less, there is going to be some kind of a discount because the LLC does not control the activities of the retirement account doesn't control the activities of the LLC. At a 50% level, it does have a veto power, so that's more control than if it has less than 50%, and other people can outvote it. But there will be, if it has less than 50% or 50% or less, there'll be some kind of a discount because the retirement account doesn't have control over how the LLC does its business. And what that gives you is the freely traded value of the minority interest. In other words, that's the value of the minority interest that it could receive from third parties if it were freely marketable. But for most multi-member LLCs, there are restrictions on whether or not you can actually transfer the property. If you think about it this way, if you've got a multi-member LLC and they're unrelated parties, they've gotten together because they want the particular person they've chosen as the manager to help them manage the property that's going to be held by the LLC. And because they trust that person, they don't really want that person to be removed by other people. So they believe each other, they know each other, but they don't want anybody to have control in order to be able to remove the manager. And also, they don't want to have an unknown party coming in because somebody decided to sell out. Because remember, in most LLCs, you also don't have the ability to cash out. If the LLC allows you to cash out, in other words, demand return of your cash at any particular time, that could impair the success of the venture. And so you can't cash the money out. Because we don't want unknown partners, then there are restrictions on the marketability of the units that are held. So there's going to be some kind of a discount for lack of marketability. So if we take that discount off the freely traded value of the minority interest, we get the fair market value of the minority interest. And that's how that's calculated. So let's take an example. Just like above, we have the net fair market value of the LLC's assets of $348,415.83. But in this case, we're valuing a 40% ownership interest. So the prorated value of the 40% interest would be $139,366.33. That's 40% of $348,415. And then what we'll do is we'll subtract the discount for lack of control. Now, determining what that discount is really what most people rely on business appraisers to do. And they do that based on their knowledge of the markets and of the private markets and similar things that are sold, and they do a lot of research, etc. So they will choose the lack of control discount, and I'm putting in 20% here because I've seen that discount or that lack of control discount used a number of times. But that 20% isn't something that's just a figure that you can plug in. That should be based on reasonable assumptions and reasonable interpretations of what other assets of a similar value or similar business venture might have as a discount there. So that discount is $27,873. So the freely traded value of the 40% interest is $111,493.56. And then we have to figure out, well, what is the discount for lack of marketability? And again, business appraisers have a lot of information that they gather about discounts for lack of marketability of similar business interests that they might find in various different ways. So in this case, we might take a 15% discount for lack of marketability. And I will tell you that in the estate area and often in similar areas like this, we find that the total of those two discounts is often somewhere in the vicinity or over 35%. So it's not unusual for people to get 35 to 50%. It's a little bit more unusual to get over 50% in combination of those two. And there might be other discounts that are added in by the appraiser. But in this case, just for our example purpose, the net value of the 40% minority interest would then be $94,769.53. So that would be the value instead of the $139,000 interest that you would report to the custodian as the value of those minority interest LLC member units. So let's take a look at what the effect of this is if you're doing a Roth conversion. So if you have a minority interest in an LLC, and you decide at some point in the year that you've decided that you want to convert, it's traditional IRA, you'd like to convert those units into Roth, and you're willing to take the income tax hit, so you need to figure out, well, okay, what is the value of my 40% interest? And you would follow the methodology. You'd probably hire a business appraiser, but you'd follow the same methodology I just outlined. So the pro rata share would be $139,000, but the reduction to your income would be the total of those two discounts of $44,597.30. So if you didn't take any of those discounts, or your income that you'd report to IRS on your income tax return because of the Roth conversion, it would be $139,366. But because it's been valued based on the fact that you don't have control and the interest is not readily marketable and you can't immediately demand your cash out, there's a reduction of the income that you're receiving of $44,597.30. And that means that you are actually saving $17,660.53 in taxes because you recognized that you had a minority interest in your evaluation. Now, some people question that and say, well, I don't get that. That doesn't sound right. Well, in fact, you wouldn't want to do a valuation of this kind on your own unless you were an appraiser yourself. And even then, you'd probably want to get a third-party appraiser. And so what you do is you go out and you ask an appraiser you tell them what the value of the inside assets are, and you might get appraisals for various different parts of that. Then the business appraiser takes all of that information and then does his or her research and comes up with a valuation using the process that I've described. So you have a business appraiser, a valid business appraisal done by a qualified appraiser, and qualified is a technical IRS term, that tells you that the value of your LLC units for purposes of converting to Roth is $94,769.53. Are you then going to report the value of your interest at $139,000? Well, no. You're actually supposed to report, you file the appraisal with your income tax return saying, this is the value of those interests that I converted, and you rely on the appraiser to tell what that value is. You can't choose 95,000, you really can't choose 100,000. There's no basis for that. Your only basis for the value is the appraisal that you get. So in that way, it's important to recognize that if you have an interest in a multi-member LLC and you have whatever that interest is, it's not the pro rata value of the assets in the LLC that is actually the value of your units, as long as you have a lack of control and you can't sell them or cash them in, then you're going to have that kind of a minority interest discount, and you can get those tax savings. So our next step is to report the value to the custodian by March 31st. Now, what does IRS do? What does the custodian do with all of this information? Well, what they're supposed to do is to report that information to IRS, and the way that they do that, let me see if I can find that form and show it to you. They file Form 5498 with IRS, and the reason that they're asking for this hard-to-value information, asset information, is because they have to file this by May 31st. So when they compile all the information, and in particular, the IRS wants to know the fair market value of the account. That's right here in box 5. And then they want to know if it's an IRA, a SEP, a simple, or Roth IRA, are there any SEP contributions, simple contributions, Roth IRA contributions? Have there been any required minimum distributions for, are there going to be required minimum distributions for 2018, and what's the date? And so what are those required minimum distribution amounts? And those are going to be valued based on what the custodian reports for the value at the end of 2017. But we're notifying IRS about what that is. So, and notice down here we have a 15A, the fair market value of certain specified assets. And then 15B is codes. Well, what are those specified assets? Well, let's take a look. If we look at down here at the explanation of box 15A and 15B, we have IRS's list of all those assets that I told you were hard to value assets, and they want the custodian to put the value of those assets in there and tell IRS that using these codes that one or more of them are hard to value assets. Remember, the custodian is also reporting any cash in your account and other marketable securities, so it has to report to IRS that in fact you have hard to value assets included in this fair market value of the account up here in Part 5. So, let me see if I can find my way back to the PowerPoint slideshow. So, no, I did not. So here we are. Here we are. Okay, so we're sharing this particular screen, and here's where we were. So the Form 5498, that form that looked red, and you're going to get a taxpayer copy that will be in black and white. That's going to have the account value. It's going to show your contributions, your Roth conversions, Roth recharacterizations. All of that is going to be on the Form 5498. So it's important that when you get it, because they're going to send it out by May 31st, unless they go on extension. When you get that form, it's going to be sometime after May 31st, more than likely. You should check the form over and make sure the information is correct. And then if it's not correct, if it's not what you reported, if they missed it, if you think it's incorrect, you need to make sure that they file a corrected Form 5498. And that for that, you'd need our help. We would contact the custodian and go through the process with them of correcting the values that they've reported on the 5498. So let's get back to this issue of choosing what your best option is to establish the fair market value of the specific assets that you have to value. So again, we talked about what the various different options are. You know, we might have a qualified appraiser, opinions of value, we use our accountant, book value, purchase price, etc. But how do you choose which valuation option to pick? Well, that's going to be an issue of a function of a number of factors, and really it's about what's at stake. What's at stake? Well, it's all about Form 1099-R and your income tax returns. So what you're going to want to do is you want to make sure that your value that ends up being the source of distribution information on 1099-R is correct. So key events for valuation is any time that there is going to be some kind of a 1099-R issued by your custodian. That's when you want to be on the highest alert that the values that you're reporting to the custodian are accurate. So there might be, for example, during the year you might have some in-kind distributions. You might have some in-kind required minimum distributions from your retirement account. Even if you're making those distributions in cash from another retirement account, you're reporting what your minimum distributions have to be based on the overall value of all of your individual retirement accounts. So making sure that the value of the account that you've got that's self-directed is accurately reported is very important. In-kind rollovers, prohibited transactions. If by accident your account gets disqualified as of January 1st, you want to make sure that the value that IRS is pinning your income to as a result of the prohibited transaction is accurate. You don't want them to be getting a value that's overvalued. You want to get them a value that's undervalued, that's not undervalued, that's accurate, so that the income taxes get reported correctly. There might be excess contributions that have been made to the account, Roth conversions, Roth characterizations, etc. And also one last important thing is that it's important evaluation if the investment becomes mature. So even if you're not making distributions, let's say that you've held an interest in an LLC or a piece of real estate for 10 years, and every year you've been reporting it at its book value, the value that you made the original investment in, because there was no other way for you to find out. But the LLC is being sold, the property is being sold, and you're now realizing the value of your investment. That might be 10, 15 times the value of the original investment. And so what happens then is if you report the value at the sale price, then the custodian is now going to report a vastly different value on your account than was reported before. And IRS does have processes where they pick that up. So they're going to want to know, well, why is that so much different now? Why is it revalued? Because of course, if there's a huge difference in the value from one year to another, and you have minimum minimum contribution requirements, then there's something off as far as IRS is concerned, and they want to make sure that everything's on the up and up. So it's important to try to keep your investment value relatively consistent over time. So what is the effect of an overvaluation? The first is that there is an increased income tax liability for distributions. Now this is not something that we worry about a whole lot, because IRS isn't going to really care if you've inaccurately reported your value and resulted in an increase in your income tax liability. And also for a Roth conversion. IRS is going to be very happy to have you inaccurately report something with an overvaluation. The real rubber hits the road when you get to an undervaluation. And the result of that, of course, is that you get additional taxes. If you're filing a return that you have an undervaluation that's the basis of your income, you will end up with additional taxes assessed on you. The IRS catches up to it. And then if it's a year or two later or more, you'll have interest on those unpaid taxes. In addition, you may have some late payment penalties because if the taxes aren't paid on time, then they're late. And you get your penalties for that. And then you have accuracy-related penalties. In other words, because you have inaccurately reported the value of something that's a source of your taxable income, there's additional penalties because of the inaccuracy of your reporting. So let's talk a little bit about that. The penalty for inaccurately reporting the value of an item, or inaccurately reporting the income items on your return, is 20% of the underreported amount due. And that is the amount if it's due to negligent or disregard of the rules, or if it's something called a substantial understatement. So let's take a look. So in other words, if you're going to file your income tax return for your Roth conversion, for example, and you undervalued the value of the Roth by 30%, then there's an additional 30% of that value that's due, that's the source of your taxes, and you should be taxed on that. So they want 20% of the underreported amount tax due. So if you've underreported your taxes by 20%, that's an underreporting penalty. You can do that either because you were negligent, or because you disregarded the rules, or because you had a substantial understatement. So what is negligence? Well, what the statute says is that's a taxpayer's failure to make a reasonable attempt to comply with the rules. And then disregard is also defined, and that is a careless, reckless, or intentional disregard of the rules. So you can be negligent, which because you didn't make a reasonable attempt to comply with the requirements of reporting, or you could be actually disregarding, which would be a little bit worse, because you were careless, reckless, or intentionally disregarded the rules. So how would you avoid a penalty based on negligence or disregard of the rules? Well, what you would do would be to use a reasonable method for that you think is a reasonable method, and that maybe your tax return preparer agrees is a reasonable method of actually valuing the interests that are being valued. Same thing with avoiding a disregard penalty. You don't want to be careless or reckless or intentionally disregard the rules. So you pay attention to the rules. You have your tax return preparer pay attention to the rules, and you use a reasonable method and make a reasonable attempt to comply with appropriately valuing the interest that's the source of your taxable income. Now let's talk about the substantial understatement. That happens when the tax reported is understated by at least $5,000, or 10% of the value that should have been reported, and that's the greater of those. So if it's underreported, but the tax is understated by less than $5,000, then you don't get a substantial understatement penalty. It has to be at least $5,000, and so that's when you get to the understatement penalty. So the understatement happens if the taxpayer did not have a substantial authority for the position that they took on the tax return, or they did not adequately disclose the relevant facts affecting the item's treatment, and had no reasonable basis for the tax treatment. So again, the way to avoid that kind of a penalty is to have substantial authority for the position that you took, and that's usually using an opinion of an attorney or a tax attorney or accountant issued with respect to the position that was taken, or actually disclosing the relevant facts on the return and having a reasonable basis for the tax treatment. So that would be how you would avoid those undervaluation penalties. So again, let's get back to choosing how to value the stock. Remember, we had for closely held stock, if we were going to be filing an income tax return, let's say for a Roth conversion, or if we had our first distribution or had a distribution in kind from an LLC, let's say for LLC interests from the retirement account, then we're probably going to want to get the value of that determined by a qualified business appraiser. And go through those two steps and those two levels of appraisal, because you don't want to get those undervaluation penalties. Now, of course, if the cost of the appraiser is going to be more than the value of the income that you're estimating, then maybe you want to take a different tack on that. But usually your preference is going to be that. And if you're going to have an ongoing distribution over time, what you might do is have the business appraiser do it the first year, and then ask them for an update based on financial statements. And all they have to do is look at the financial statements and give you a letter that updates the value every year. You don't have to go through the full-blown valuation process. Again, you might have an agreement between the shareholders that determines how they agree that the value on the value, and if that's the source of something that is an economic issue between the owners, then that will probably be respected for valuation purposes. For long or short-term debt obligations, of course, you can certainly use the principal balance plus the accrued interest. That will be the one that IRS won't pay much attention to. They'll say, okay, that's the balance and then the accrued interest, and they'll probably accept that. But if you wanted to have it determined by a qualified appraiser and have them consider the effects of security and defaults and history, then you might choose to have an appraiser, depending on the size of the note. So if you're going to distribute out a promissory note from your retirement account, and it's a good deal of money, you might want to actually have an appraiser. It might be worth your while to save the income taxes by having an appraiser take a look at what the actual value of those notes is. So then there's the ownership interest in the closely held LLC or partnership. Again, if we're going to have a taxable event and the cost of the appraisal is going to be worth it compared to the amount of taxes that we might be incurring, then we're going to probably use a qualified business appraiser. And again, we might have a formula in a business buyout agreement between the members that gets reviewed every year by the accountant and or voted upon by or approved by the members, and that too could be a source of valuation information that you could rely on if a business appraiser wasn't economically feasible. Same thing with the real estate. Again, the purchase price is going to not be so accurate after a time because, of course, the value of the real estate usually grows. Sometimes it contracts, but usually it grows. So if you're really going to have an issue about your tax returns, you're probably going to want to have a qualified real estate appraiser because you want to have some comfort that, in fact, the value is what you can rely on. You're not going to have to worry about reporting penalties if you've got a qualified appraiser who's giving you an appraiser. If you're not really that worried about, if you're not really getting a distribution with regard to the real estate, but you have to report to the custodian, you might ask a real estate broker's opinion ask for a broker's opinion of value because you're not going to incur any income tax as a result of that reporting. You're not making any distributions, you're not converting it to a Roth, and hopefully you're not having a prohibited transaction that will disqualify the account. So you typically, if you're really concerned about making sure that you have the value, a reasonable basis for having reported the value in a certain way, then you probably want to use a broker's opinion of value unless you're dealing with distributions, and then you might want to re-examine the issue of having an appraiser. Ownership interest in a trust, same thing, qualified appraisal. Again, we have the same factors for option contract, etc. So really the issue then to be considered is how comfortable do you feel with the value that you're reporting on your income tax return. So let's say, for example, you had a Roth conversion or an in-kind distribution and you're reporting the income to IRS. You want to make sure that you're reporting your income accurately so you don't incur those penalties and you don't have to come up with extra tax money later on and interest and all that stuff. So you want to have a reasonable basis upon which you are filing your income tax return. And so, by the way, does your accountant. They want a reasonable basis for preparing the return because they have liability relating to the accuracy of the return. So you're going to look for a reasonable basis and make your choice based on what are the economics of the income tax. If the taxable income is $5,000 and it's going to cost you $12,000 to get a business appraisal, and it's a one-time thing, you're probably not going to get a business appraisal. You'll probably try to find some other reasonable basis to come up with a value on what those units are, like financial statements or something like that, so that you have a reasonable basis upon which to make the report. So to summarize, be aware and schedule the key annual dates for valuation events in your calendar so that you're aware of when things are supposed to happen. Report the value of the hard to value assets to your custodian on time, in other words, by March 31st, so that the 5298, the Form 5298, I'm sorry, 5498, comes out on May 31st, and that is accurate, because otherwise you're going to have to backtrack. If you're reporting it late, then they're reporting it to IRS based on a prior value, and that may cause you some problems. And understand how to calculate the fair market value of your single or multi-member LLCs. And just so that you're aware, we are going to be providing a methodology for our self-directed retirement account owners in our Set to Safeguard program. There will be a nominal charge for that, of course, but because it's a new service, but we'll be assisting clients for this calendar year 2017, if they want it, to report the value of their LLC units to the custodians. And then for specific hard-to-value assets, we want to make sure that we choose a reasonable valuation option based on your practical tax reporting needs. So you want to be able to defend your reporting of the IRS, your reporting to the IRS on your income tax return, that you had a reasonable basis upon which to file it, that you had a reasonable position that you've taken on your income tax return, that there's no basis upon which to assess an understatement penalty through negligence or understatement. And so then you can only have the problem of paying the taxes that you should have paid before, and any interest and late payment penalties that you might have. But you don't have to worry about those accuracy related penalties because those can pile up. So I want to thank you all very much. I wish you all happy holidays, and I look forward to talking to you in 2017.